March 2026 is officially the most volatile month of the year for dividend investors. While the headlines focus on basketball, smart money is focused on the big four dividend ETFs: DVY, DGRO, VIG, and SCHD. This month, these funds aren't just paying dividends. They are performing a total roster overhaul. We are talking about billions of dollars in hires and fires as these funds rebalance for the new fiscal year. In this video, the specific rules for these rebalances are analyzed. The stocks currently on the bubble for removal are identified, and factual 5, 10, and 15-year backtest data is provided to show the true cost of choosing yield over growth. This content is for entertainment purposes only and does not constitute financial advice. First is the veteran, DVY. This fund weights by yield, not market cap, making its March rebalance a high-stakes event. Unlike other funds that focus on quality scores, DVY is a pure income play. The March rules. To stay on the roster, a company must have a 5-year history of dividend increases and a sustainable payout ratio. The 2026 bubble analysis shows 3 major names on the bubble: Seagate Technology, STX, Ford, F, and Altria, MO. These companies are facing pressure as their payout ratios fluctuate near the fund's strict 5-year dividend sustainability limits. If their cash flows don't support the yield, they face removal on March 17th. Let's look at the numbers. I will assume a weekly contribution of $100, totaling $5,200 annually, with all dividends reinvested. DRIP. Calculations are based on historical price data and dividend distributions. At the 5-year mark, total investment. This equals $26,000 over 260 weeks. Growth. DVY experienced a modest capital gain of $3,270 because this fund leans heavily into old economy sectors like utilities and financials. It didn't capture the tech-fueled highs. Dividends. Reinvested dividends added $3,386 to the portfolio value. Interestingly, in just 5 years, dividends actually contributed more total value than the stock's price appreciation. At this point, the portfolio now generates approximately $560 per year or $47 per month in passive dividend income. At the 10-year mark, total investment. This equals $52,000 over 520 weeks. Growth. Capital appreciation reached $15,365. While positive, the growth was slower compared to more diversified ETFs. Dividends. Reinvested dividends account for $15,633 of the total value. This is where the yield engine is most obvious. The dividends have officially matched the price growth, effectively doubling the total return through reinvestment alone. Current income. The yearly dividends, about $3,000 in monthly income, would be about $250, covering about 57% of your ongoing $433 monthly investment, $100 a week. Next is DGRO. The focus here shifts from high yield to dividend growth and sustainability. The March rules. DGRO requires a 5-year growth history and a payout ratio under 75%. The 2026 bubble. Due to the massive tech rally of 2025, several growth-heavy names like Broadcom, AVGO, and Microsoft, MSFT, have seen their yields drop below 1%. Because DGRO looks for a balance of yield and growth, there is a high probability these names will be trimmed to make room for value stocks like Target, TGT, or Merck, MRK, that have more attractive entry yields right now. Let's look at how these numbers have worked out for an investor. I will still assume a weekly contribution of $100, totaling $5,200 annually, with all dividends reinvested, DRIP. Calculations are based on historical price data and dividend distributions. At the 5-year mark, total investment, this equals $26,000 over 260 weeks. Growth, DGRO saw a capital gain of $8,576. This is significantly higher than DVY. Dividends. Reinvested dividends added $2,706 to the value. While its yield is lower than some other ETFs, the rapid growth of the underlying share price makes each reinvested dollar work harder. At this point, DGRO yearly dividend was $840 or $70 per month. At the 10-year mark, total investment, this equals $52,000 over 520 weeks. Growth, capital appreciation reached a massive $41,304. DGRO's strategy of picking profitable growers allowed it to capture a larger share of the bull market over the last decade compared to high-yield-only funds. Dividends. Reinvested dividends account for $15,398 of the total value. The dividend growth aspect is key here. As the companies in the fund raise their payouts, reinvestment amounts grow larger over time. Current income, yearly income, was about $2,400 per year, which equals $203 per month. Interestingly, this covered about 47% of the ongoing $433 monthly investment. At the 15-year mark, total investment, this equals $62,400. Note on time frame, DGRO launched in June 2014. For the 15-year calculation, we are using the maximum available data, approximately 11.5 years, to show the full potential of the fund since its inception. Growth. Portfolio would be worth $150,249. Capital appreciation contributed $62,582. Dividends. Reinvested dividends added $25,267 to the portfolio. Even though the time period is shorter than a full 15 years, the total value is extremely competitive because of the fund's high growth rate. Portfolio produced $3,360 per year or $280 per month. Third in the bracket is VIG, the most exclusive club in the tournament. The March rules. This is the gold standard of dividend funds. It only accepts companies with 10+ years of consecutive hikes. The 2026 bubble. Stocks currently on the bubble for VIG include those in the financial sector that may have frozen dividends during the high interest rate volatility of early 2025. VIG's rules are binary. If a company missed even one hike, they are out. Let's look at the numbers. I will assume a weekly contribution of $100, totaling $5,200 annually, with all dividends reinvested. DRIP. Calculations are based on historical price data and dividend distributions. At the 5-year mark, total investment, this equals $26,000 over 260 weeks. Growth. VIG's price rose from approximately $139 in 2021 to over $226 today. This resulted in a capital gain of $8,346. Dividends. The portfolio now generates approximately $47 per month in passive dividend income. Not life-changing money, but enough for a good dinner every month. At the 10-year mark, total investment. This equals $52,000 over 520 weeks. Growth. In 2016, VIG was trading at approximately $77. The long-term price appreciation of your $100 per week contributions has yielded $39,605 in gains. Dividends. The power of compounding becomes visible here. Reinvested dividends account for $10,756 of your total value and generate approximately $1,607 per year or $134 per month in dividends at the 15-year mark. Total investment. This equals $78,000 over 780 weeks. Growth. Starting when VIG was roughly $55, your principal has more than doubled through price growth alone, adding $100,204 in capital appreciation. Dividends. Reinvested dividends have contributed a massive $34,710 to the final balance, showing how dividend growth and share accumulation accelerate over long periods. The portfolio is now a significant income engine, producing $3,342 per year or $279 per month. The value added by reinvested dividends, $34,710, is nearly half of your original total investment, $78,000. Finally, the heavyweight champion, SCHD. The March rules, SCHD scores the top 100 stocks based on cash flow to debt, ROE, and dividend yield. Its March overhaul is the most anticipated event of the month because it can result in the entire fund rotating into a different sector. The 2026 bubble, keep a close eye on Chevron, CVX, and Amgen, AMGN. If their return on equity has dipped below the fund's threshold, they will be replaced by higher-scoring value names like Texas Instruments, TXN. The rebalance date is set for the last week of March. Let's look at the numbers. I will assume a weekly contribution of $100, totaling $5,200 annually with all dividends reinvested, DRIP. Calculations are based on historical price data and dividend distributions at the 5-year mark. Total investment. This equals $26,000 over 260 weeks. Growth. SCHD had slightly lower capital gains, $4,533, but significantly higher dividend income. Dividends. Reinvested dividends added $3,296 to the value, nearly double the dividend contribution seen in the VIG scenario. At the 10-year mark, total investment. This equals $52,000 over 520 weeks. Growth. Capital appreciation reached $26,025. Dividends. Reinvested dividends account for $16,975 of the total value. Because SCHD's yield is higher, the snowball effect of buying more shares with those dividends is much more pronounced here. Current income. Monthly income is $265, which covers more than half of your monthly $433 investment, $100 per week. Total yearly dividend payments are $3,180. 15-year horizon. Started October 2011. Total investment. This equals $78,000. Growth. Starting at $0, the portfolio is now worth a staggering $203,781. Dividends. Reinvested dividends account for $51,622. Current income. The portfolio now produces $569 per month. This is the tipping point. Dividends are now paying more each month, $569, than out-of-pocket contributions, $400. While VIG ended with the highest total balance, remember that SCHD and DVY provided more liquid cash throughout the decade due to their higher initial yields. Furthermore, if a strategy had been split equally, investing $100 per week across all 4 funds, the total contribution of $208,000 over 10 years would have resulted in a combined portfolio value of approximately $446,900. This demonstrates the power of consistent contributions and diversification across different dividend styles. As a reminder, these numbers are based on factual historical data and are not a guarantee of future performance. March 2026 is a pivotal month for these funds. Monitoring the upcoming rebalances will provide clarity on which sectors are favored for the remainder of the year. If this analysis was helpful, please like the video and subscribe to stay updated on upcoming videos.